Good evening, the Ken of Tortoise Capital Nightly Strategy Podcast for August 27th, 2022. So, got some notes from Ken Hum here. We're going to take a look at his charts, and our conversation is that he's looking for psychological aspects of his entries. Because of the recent choppiness, he's been seeing the emerging dragon and taking that breakout rather than taking the SSC, which is a lower risk, but might have more back and forth because of consolidations. And he asked me my thoughts on that. All right, so the situation that we're looking at here is typical of the market right now on August 27th. We had a period of price moved up to a measured high. It rolled over, crossed the dragon, flipped the PSAR. Now the PSAR is cruising down. Price rolls down, bottoms out. The RL10 reverses, crosses the dragon, then crosses the PSAR. And then there's a potential of entering at 1, which would be like an SSC. Or entering at 2, waiting for that price to come up and take out the previous peak of the dragon, peak of the RL10, or the previous PSAR. So all of those are happening at about the same time. So we would call this an emerging dragon, an ED, and this is the SSC. Now the difference between those two is the price inside what we think of in the purple as the pocket. And that's that space between the SSC entry and the emerging dragon entry. Now, the idea is that if you wait for the emerging dragon, you're going to get a higher percentage payoff because it is clearly broken out from the previous high, and now this thing is off and going to run. All right, it's off and running. Whereas if you stay with the SSC, you may get some backing and filling and then some failures. The attraction of waiting for entry number 2 is that you get the higher probability. The cost of that extra certainty is that you don't get the value from the earlier entry. Like you miss this. The cost of taking the earlier entry is that sometimes this fails and there's some re-entries or stops and reversals or maximum uncertainty. The important point to notice is that the stop level on both of these is the same. A price below the lowest, where the PSAR flipped, or the belly of the RL10, that's the signal that this price is not going up, but instead is rolling over and failing, and we would call that the collapsing dragon. The advantage of the SSC entry, of entering here, where it crosses the PSAR, is that your risk box is really small. The amount of indecision that you have is only this. So your 1R execution risk is small, and you probably have 2 units of reward in hand before you ever get to the emerging dragon entry, which would be up here. The emerging dragon entry is up in this space here, where it's taken out the previous high. So for the extra indecision, you're getting compensated by 2 potential units of risk. Now, the thing I want to point out is that your risk box on this entry is still all the way down to the collapsing dragon. So now the risk that you're taking, the signal that tells you that that trade is not working, is still this. Because if you enter if you enter at 2, and if you exit any place earlier than the thick red line, your the bottom of that risk box, any exit inside of this space here is you're exiting in the noise. You don't have a confirmation that the downward trend is continuing, because here's the downward trend. And that's not reinitiated until it breaks below the previous low. So any exit inside this is a probability anyway. It's the same probability that you had that the SSC was going to fail on the way up. Why? Because it's in the pocket. It's in this noise zone between this pocket right here is in between the two price levels of certainty. The price levels of certainty are where the dragon rolled over and where the dragon rolls over. All of that space in between is uncertainty. So you just got to live with that. And it works in both directions. So if you decide to take, and I'm not saying one of these is right or one of these is wrong, but you need to know what the dynamics are. If you enter at 2, what you're getting is the increased certainty that you're not going to be chopped, but you have to accept that your risk box is going to be that much larger. So your position size, if you will, would have to be smaller because you're taking a wider risk. So I prefer this entry here at 2, because I'd like to have the smallest possible risk box, the minimum manageable risk box. And if this thing fails like I expect it to, I'm not surprised when it fails. I actually want it to fail, because the collapsing dragon entry is my favorite entry. I want that thing to fail because the most recent trend was this one. But I'm willing to get paid for taking the risk of the uncertainty of this move. I'm willing to get paid. I've got a 2-to-1 reward to risk ratio. And then if this higher level does get breached, so at 2, wherever that emerging dragon is happening, I've actually got confirmation that my first trade worked. I've already got 2 execution R in hand. And if it starts to fail right where it failed the last time, I'm going to put a winning trade in and get paid for willingness to take on the risk of uncertainty. The main point I want to make out of this is compare the size of the 2 risk boxes. Here's the risk box that you get by taking the SSC. The amount of indecision is small because it doesn't take much to prove that it was wrong. And then the size of the risk box on the emerging dragon is larger. You have to put up with the larger risk box because it has further to go to prove that it was wrong. That's the main point of this idea. So that's the essence of the decision making of the SSC versus the emerging dragons. We'll see how that shapes out in some of Ken's patterns here in a minute. All right, now we're looking at Chi-Weng Chong's RL 30 slopes scores. And we're noticing that the market, finance, tech, and materials have all peaked up around Z+2 and are rolling back towards the mean. The routine giving back of price after a long, strong move off the bottom. Energy has been lagging and is also starting to flatten out. So this is a broad phenomenon of the market slowing down after an amazing 30-period run. So nothing surprising there. So notice the convergence coming back to 1.0. This will determine if this is a buy on dip opportunity. If it's a buy on dip, then it should hold somewhere around slope of 1.0 this week and reverse back higher above zero, much like it did here. And at the turning point here, notice how this was the last time it compressed. Then what we got paid for on last time was to see after the rollover, which was the sector leading the way north. In this case, it was tech, the broad market, finance, materials, and energy both got murdered, while tech led this most recent move to the upside. They're all kind of giving way together on the way down. So don't know how far it's going to go, but it will be interesting to see which one starts holding first. That is the probability of the next sign of leadership. In the same way that we looked at this convergence and saw that tech was losing less and started to gain sooner and tended to pull the rest of the market up with it, and then finance joined. So we'll be watching for that kind of leadership. And now in the battle between XLY, the consumer discretionary, and XLP, consumer staples, we're seeing weakness in both of those. Even the staples are giving back. Now they haven't given back as much as the discretionary in the market. So this may very well be receiving money as people are cashing their wins and rolling it into defensive plays like Walmart, Coca-Cola, McDonald's. That can account for why these are not failing as much. In the same way that this looks like everything going up together and then money rolling out of defensive plays into the aggressive plays. This is probably money rolling from aggressive into defensive plays. So it wouldn't surprise us to see staples have a good run here. So we'll be watching that dynamic as well. All right, now we'll look at a series of trade frames from Ken H. So this is Devon Energy. Energy's had that nice recovery. This was that move that made energy suffer so much in terms of slope statistic that we saw on the previous chart. Ken H has been trading the turn. See, again, he waited longer than the pure SSC. This is a natural exit point, whereas the SSC gets paid waiting for this little recovery and resumption. That's like a COTA 2. There wasn't as much upside available. So whereas this is a winning trade, that's a scratch. On the intraday, he did get an entry here, second position, third position. So that's what these trades look like on the hourly charts. Here's the COTA 2 breakout. See, he waited for the emerging dragon instead of the COTA 2 or the SSC. So both of those would have paid off. Now, on the hourly chart, this is probably the better exit when the PSAR flips, but he at least gave it some time and some room. He got out at a scratch and avoided this mess. Now he was able to get the SSC. Now that he had one position in, he doesn't have to take the COTA 2. He can afford to wait for it to clear the emerging dragon. He did the same thing here. Could have added as early as this, but this is a clear breakout from the emerging. Now, note that's what he's given up, though, is not taking the earlier signal with the increased uncertainty, but he is getting the better payoff. He was probably white-knuckling it right here. It held, it resumed. Now he takes the COTA 2, and now he's snugged it, all three winning positions into here. So this is in great shape. His entry here at 57 is probably using a $2 risk box. So he's got from 56 to 72 on the first position. That's $17 off a $2 risk. So that's an 8R trade. This is about a 3R, and that's about at a break even plus dinner for two right now. So great shape on Devon Energy. We'll see if energy can continue to go. It's pushing towards a recent resistance area, so we wouldn't be surprised if this failed. And this is richly valued. He wants to make sure that he's preserved and protected that gain. So he's in great shape there. Uranium, we talked about that one earlier. He's got the first little swing trade entry. He gets paid. He did not take the short. He waits for the emerging dragon once again. Now, this is in the money, but yeah, should have exited. I would agree. Just noticing how vigorous this thing can be. A bird in the hand is worth two in the bush. So that's a good exit plan right there. I would probably be short if that hit. But if this works, I'd be looking to add above 22.75. This is still in early days on the weekly basis. 28 and 29 are in play to the upside. So we've got room for tradability on this one. The immediate issue is getting from 22 to 23.5, and then can it breach above that? So we'll see. So uranium for the long run. Clean energy. This is a great shot in getting paid. This swings so often that you're far better off getting paid on the swings. And sometimes those will work. So this was a great entry on the hourly. And what he's looking to see is, can it break through the top of the dragon at 61 to get to 65 and have this kind of a move? It didn't. It rolled over at 61.50. So he gets paid for taking the risk. And now this is in a critical state ready to break out to the upside, which is tradable. That's $3. And this is tradable to the downside. That's $2.50. So he's in great shape. And you just notice that clean energy swings nicely. U.S. Steel. Here was the SSC. First entry. Second position. Scratch on the second one, gets paid. Re-entry. Great shape. He's holding firm right there. If this breaks above 26, this thing's free and clear till 31, so this is in great position, but he's going to get paid for taking the risk. I would be adding above 26. That looks good. DBA is early in the swing. Notice this is a COTA 2 and getting ready. If it can break above 21, this move to 22 and then 23 is well in hand. We're on the correct side of value on the long term. This is one where I like the hourly breakouts for the SSCs because they get paid. This is the inflation trade. DBA, Deutsche Bank Agriculture Futures. CF Industries, this was from the Sniper report. Clear breakout, nothing holding this back. Off we go. We'd like to have seen that one at the turning point. Jiminy Crickets, and then the COTA 2. But there it is. That's a fireworks and ready to resume. And then a failure, I think I think you could play this tactically below about 115 to play down to here, but waiting for this to break, that would be the obvious one. But there's a trade inside there ready to go, but my spider sense is this thing is off and going, and that's agricultural imports. I think that one is a nice way to play the ag. The Qs, he's trading this one a lot. He's getting paid a lot. Here's a gain. Here's a short and a cover. Here's a stop and reverse, 2 positions, and he's in the money. Waits for the short on this one here. He was waiting for the collapsing dragon. Good quick stop and reversal. And now we're waiting to see which way this is going to break. I'm ready to see this break in either direction. The move to 296 would be normal, and the move back north of 326 would be normal. So we saw that in the RL30 slope stats. This is a market that's in a compound critical state. This could hold support. Here it was trying to hold support and failed. Here it held support and gained. So this is a coin flip where it is right now. We'll see next week. A great intraday trader. Not interested in swinging it. Coinbase has had its beautiful run to 106. He got paid. He's now short. He's got a stop locked in right here. If this fails, it's back down to 52. That's in great position to exploit a return to 55. A great trader. This is not one to be believing in. This is a pure trader. Treasuries has already started to make the turn. It held at 111. If the market gets weak, this move to 119, 120 gives you a 7% move. This is very tradable. If the market gets weak, look to see that COTA 2 get reinforced. And then the safe trade, if there is such a thing, is 113 to 119. That's the window of opportunity. This is trying to hold at a higher low on the weekly as well. Nice swing trade developing. SWAV, Shockwave, great shape, great stop. Add more if it gets above here. Free and clear. That's from the fireworks pattern. CCRN, cross country healthcare. He waits for the CATA 2. So the CATA 2 works here or here, or I mean the SSC works here or here. I prefer this one because of the gap. He locks it in. It's had the run. I don't mind this at all. This thing could very easily break above that, but you can see why we're not surprised that it failed here, because it failed here 3 times. So getting the exit would be okay. This one locks in again. If this resumes, you could add above 2750 with the idea that it'll look like this running to 30. And there's room for it to run to 30. And this was really just a one-day sell-off anyway. So you've locked in some gains. And if this works, it's a nice CATA 2, and that'll just look like noise. But if it fails, you made some bank and got paid for taking the risk. So I'm not worried about that one. UNM Uhura Group. This is in financial services. Here was the PSAR flip. There's a CATA 2. There's an emerging dragon. He's late on this one. So this one he's really looking to play with a small risk to 40, or if it collapses down to 38, if 38 collapses, adding positions. So this one is a fireworks play. And as long as it stays above 38, it has all of this momentum behind it. But if it starts collapsing at 38, then it feels like it's in this channel from 38 to 32, and then all of these gains would be lost. So that's a nice looking daily breakout. If you just wait till above 40, you're all right. Get short at 38.80. You should be in good shape. That's a good pure tactical trader right there. That's a fireworks pattern. CLFD is fireworks as well. This is why we like the range compression, and then the breakouts, and the emerging dragon would be nice. The SSC would be nice. Oh my goodness. Sometimes those things happen. He was able to get this one here after a long run. It took a while to persuade him that the fireworks were really fireworks. But this is where the CATA 2, the emerging dragon, the second emerging dragon, but he's in the money, and he's got a couple layers of defense. And on this one, he decided to just get locked in and gain. But I like this one for the longer term, because all of the people that bought through here are waiting to buy more on buy on dips. So if this holds north of the PSAR, I think you could play the upside and get the re-entry just fine. All right, that's everything we got for today. We'll be at the soccer match, and we'll be ready for European storytellers in the morning, and then some Q&A sessions, and then some more work tomorrow night. So take good care, and we'll see you tomorrow.